Good morning, everybody from London. My name is David Russell. I'm chair of the Transition Pathway Initiative TPI Limited, an asset owner-led board that owns the brand for TPI and helps set up the Transition Pathway Initiative. Welcome to this webinar entitled Navigating the Coal Transition. It's one of a series of webinars that the TPI Centre, our academic partner at the London School of Economics, produces roughly every 6 weeks to raise the profile of the research that the TPI Centre is undertaking and to showcase the results and the analysis, enabling people to have access to that information. Recent webinars have covered food producers, the banking sector, looking at how the TPI's management quality and carbon performance scores compare to the Climate Action 100 Plus benchmark. And the latest set of presentations just a few weeks ago was looking at the net zero standard assessments for the oil and gas sectors and diversified mining sector. This morning, you're going to be hearing about the latest results from the carbon performance assessments for the coal mining sector. But first, a very brief introduction to the TPI and a bit of background on the organisation. The TPI was launched in 2017 by a group of asset owners who wanted to understand how the companies that they were investing in were going to transition to Paris alignment net zero with the TPI Centre at the London School of Economics, where we've had a long-standing relationship since 2016, in fact, and also working with FTSE Russell, part of the London Stock Exchange group, who provide some of the data for the management quality score assessment that we do. As I said, the aim here is to provide information to asset owners and asset managers to enable them to understand how companies are transitioning. And in fact, we also now do a country assessment, and I'll come to that in a moment. The assessment process are built around a small set of principles. The research undertaken and the data assessments have to be academically robust, and that helps us with the basis of the relationship with the London School of Economics, a leading international research and education centre. We base the assessments on public disclosures only. TPI does not send a questionnaire to companies, and then the assessments are done in a black box. All the data that are used underlying the assessments is publicly available in TCFD reports, in CSR reports, in company annual reports on websites. The processes and methodologies used to make the assessments are also publicly available, so people can understand how the assessments are undertaken. But most importantly, the results of those assessments are open access, so they can be downloaded from the TPI Transition Pathway Initiative.org website to enable investors to just use the data. You don't have to pay for it. We have roughly 150 supporters globally, representing something in the order of $80 trillion worth of assets, although that number does move as asset prices go up and down. And we're always looking for more supporters. So if anyone's watching who aren't currently a supporter, please get in touch with the TPI. The TPI Centre, our academic partner, works in 4 main areas. The company assessments are an assessment of management quality, which is the governance of the transition, and also a carbon performance score, which assesses how companies are setting targets against sector-specific transition pathways. TPI Centre also undertakes ASCOR assessments, that's assessing sovereign climate opportunity and risk, looking at how countries are transitioning and what policies and processes they're putting in place so that they transition and their underlying economy transitions. There's also a banking assessment, very specifically looking at how banks are putting in place processes to transition. And finally, the Climate Action 100 Plus, the big international engagement program, TPI also provides a significant input into the benchmarking approach that is done as part of the CA100 assessment. Today's webinar will present the latest results from a carbon performance assessment for the coal mining sector. As everyone knows, transition away from thermal coal in particular will be critical if we're going to achieve the Paris alignment or net zero by 2050, and it will be an essential part of the decarbonisation of the electricity supply centre, which we will have to depend on to achieve net zero. I'll now hand over to Ali Amin, who's a policy fellow and research project manager at the TPI Centre, and he's going to run you through the programme and the administration around that. I hope it goes well, and enjoy the session. Thank you.
Great. Thank you, David, for the introduction, and thank you to everyone who has joined us today. My name is Ali Amin. As David mentioned, I'm the Research Project Manager at the TPI Centre, mainly looking after the carbon performance tool. David has kindly gone through the purpose of the webinar today, so I won't repeat those points, but in terms of what to expect for the next hour or so, I will please kindly request Alex if you could share your screen so the audience can see the agenda. Great. Next slide, please. And hopefully everyone is able to see the slide that Alex is sharing. So David has done his introduction. I will provide an introduction to TPI Centre and a bit of background on the coal mining sector in general. We will then hear from Nicholas Hastreiter, who is a policy fellow and also a PhD candidate at LSE. And Nico will be covering the carbon performance methodology in more detail. We will then hear from Hayon Cho, who's a research analyst at TPI Centre and also the coal mining sector lead. And she will present results from our first assessment cycle in the coal mining sector. Finally, we're hoping to have a fruitful and productive discussion, which I will be moderating on the transition risks and opportunities presented by the coal mining sector, covering both sectoral and regional nuances. And in addition to Nicholas and Hayan, we will also be joined by Mathilde Menard, who is the Deputy Director for the Environment Directorate at Organisation for Economic Cooperation and Development, or in short, OECD. And we also have on the panel with us Jason Mortimer, who is the Head of Sustainable Investment at Nomura Asset Management. And finally, we'll end with some Q&A. Before we begin, I have a few housekeeping remarks. There will be an opportunity for you to post questions throughout the session and at the end of the panel discussion. So please use the Q&A box at the bottom of your screen to ask us questions. You can also use the function to upvote so we know which questions you want us to answer more than others. Finally, an important remark, this webinar is being recorded and will be made available on our website at transitionpathwayinitiative.org, and you will also receive an email whenever the recording has been made live. And with that, we are good to start the presentation side of the webinar. So if I can request Alex to please move to the next slide. To begin with, who is TPI Centre and what we do, David kindly touched upon these points already, but just to give you a brief understanding so everyone knows the work that we do here. So we're essentially an independent, rigorous source of research and data into the progress being made by different entities, including corporates and sovereigns, in the transition to a low-carbon economy. We're a research partner of Transition Pathway Initiative, which itself is a global asset owner-led initiative supported by asset managers and service providers. And how we essentially add value or provide the research is by providing detailed and transparent methodologies which can be used to assess entities. And a core component of most of these frameworks and methodologies is by monitoring or creating the pathway trajectories for these entities and understanding whether they aligned with international climate goals, including the most ambitious, of course, the 1.5 degree temperature goal. We're always proud to say that we are an open access tool, which means all of the data and methodologies that we produce are publicly available on our website. And one of our core principles is also that we are aligned with the existing reporting frameworks, and that's to avoid additional reporting burden on entities and make sure that we're using most of the information that is readily available on company or entity websites. Next slide, please, Alex. Topic of today, and I'm sure none of these stats come at a surprise to the audience on the call. But these are here to have you all acquainted with the scale of the challenge that is presented by coal as an energy commodity and our dependency on coal as a society. So in terms of its carbon footprint, coal is responsible for just about a third of total methane emissions related to energy production. And when we look at this from a carbon perspective, it's responsible for around 40% of global energy and industrial CO2 emissions from coal combustion. But it doesn't just stop there. As well as being used as an energy commodity, so coal accounts for 35% of global electricity generation today. It's also used as a feedstock. So one of the main prominent uses of coal is within steel production. So it's used as a feedstock for coking, where you add the carbon content to iron in order to give it the properties that we so very much desire about steel, which is many refer to as an indispensable commodity of today. And of course, the form of coal which is most used in this use is metallurgical. Next slide, please, Alex. So now I will hand over to Nicholas, who can take you through how exactly we assess coal mining companies in this sector. Over to you, Nicholas.
Thank you, Ali. And next slide, please. So before getting into the methodology that we've developed at TPI to assess coal mining companies, let's take a step back and look at the role of the coal mining sector in a net zero transition. So here on the left side of the slide, you can see how the International Energy Agency, the IEA, projects thermal coal supply and metallurgical coal supply in their net zero by 2050 scenario. And unsurprisingly, both projections are characterized by very steep declines. So the decline is even steeper for thermal coal in the medium term until 2030 than for metallurgical coal. But for both types of coal, the projections reach almost zero by 2050. So to put this into numbers, thermal coal is expected to fall by 92% between 2023 and 2050, and metallurgical coal by 91% over the same time horizon. In order to facilitate this phase out of coal, the IEA expects that certain milestones will be met in the global economy. And a very important one to note here is that thermal coal is expected to be phased out completely from electricity generation on a global level by 2040. Something else to note is that some of the emission reductions in the coal mining sector can come from the demand side through so-called carbon capture and storage. We also call them customer mitigation actions. Nevertheless, when you look at the left side of the slide again, it's very clear that the main driver is indeed the decline in coal production. So we can see that there is some scope for customer mitigation actions because still in 2050 in a net zero scenario, there will be some thermal coal and metallurgical coal in the economy, while at the same time, it's assumed that global emissions have reached net zero. Nevertheless, again, looking at simply the projections of coal production, we can see that the main decarbonization challenges lie rather on the supply side. Next slide, please. So what does this mean for companies that want to transition? Broadly speaking, there are two main decarbonization strategies that companies can follow. And the first one is a so-called diversification strategy. So here, companies essentially aim to diversify their product portfolio away from carbon-intensive assets such as coal into low-carbon minerals and metals that are needed for the low-carbon transition. And this is a strategy that we've been able to assess at the TPI Centre already for more than 5 years using our diversified mining methodology. So it applies mostly to diversified mining companies. Yet, there are also pure coal players who have so far not signaled that they want to diversify their product portfolio. And for these companies, or specifically with these companies in mind, we have developed our coal mining methodology. So a pure coal player, in order to align with the 1.5 degrees scenario, will primarily have to wind down its coal assets. And that's very much the goal of our methodology, to see at which pace they need to wind down these assets. Nevertheless, you will see that there is a small yellow arrow on the slide connecting the wind down strategy with the diversification strategy. And this is to highlight that these two strategies are not mutually exclusive. So it's very much possible that as an investor, you might be interested in a diversified mining company that has also a coal business. So potentially you want to see pitched at the corporate level how the company is doing and its transition efforts. And that's where you would consult our diversified mining assessment. But then you maybe also want to zoom in on the coal business and you want to understand how they're planning to wind down their coal assets specifically. And that's where you can in tandem then also consult our coal mining assessment. Next slide, please. So far, TPI has followed the sectoral decarbonization approach, short SDA, in all sectors that we assess on carbon performance. Yet we've decided to develop a new approach specifically for the coal mining sector, and let me explain why. So the standard sectoral decarbonization approach, the SDA, always starts importantly with a finite carbon budget. So it's a carbon budget that is consistent with a specific temperature outcome, such as 1.5 degrees. This carbon budget is then allocated to different sectors in the economy, and this happens through the use of an integrated economy energy model. So essentially, this model tries to allocate the carbon budget in the most cost-effective way to different sectors, and it also happens under the consideration of certain social and political factors. What we do then at TPI is we use the sectoral emissions budget, an output from this model, and we also use the sectoral activity projections. We divide the budget, the emissions budget, by the activity projections, and that is how we obtain our emission intensity benchmarks. Why does this approach not work well in the coal mining sector? Primarily because, as I've already mentioned, the main decarbonization route of a coal mining company is to shut down its assets. This implies that there's almost no scope in the global economy to expand coal business. This is a major difference with other sectors because it implies that carbon efficiency is becoming almost irrelevant in coal mining. So when you think about, for example, an electricity company, electricity generation on a global level in a decarbonization scenario is expected to grow because we need to electrify the economy. Hence, it's very important for a company that is aligned with 1.5 degrees to be able to generate more electricity, but as carbon efficiently as possible. Therefore, in the standard SDA case, which we can, for example, apply to electricity, you would see that an aligned company's pathway, emissions pathway, is characterized by a decline in carbon intensity. Yet if we were to apply the same approach to a coal mining company that is aligned with 1.5 degrees, this carbon intensity pathway would resemble a flat line. And that is because in order to align with 1.5 degrees, a coal mining company needs to wind down its assets. So it's called production. That is the denominator of the carbon intensity. And at the same time, in tandem, emissions related to coal mining in the numerator would fall. Hence, if the denominator and the numerator fall in parallel, the carbon intensity stays flat. Next slide, please. This is why we've developed a new approach, which we call the emissions contraction approach, short ECA. And this approach follows the SDA, but only up to a certain point. So we also start with a finite carbon budget, which is allocated to different sectors using the economy energy model. But then we take the sectoral emissions budget without essentially considering the activity projections, and we convert these sectoral emissions budgets into absolute benchmarks against which we can assess companies. What this implies is that with the ECA, we do not focus on carbon efficiency, but we focus instead on the relative change in absolute emissions, so on the percentage change. In other words, we focus on the rate at which coal mining companies should reduce their absolute emissions. What this means is that whereas an aligned coal mining companies on a carbon intensity basis, as explained, would have a flat carbon intensity pathway, using the ECA, we can see that absolute emissions are expected to fall. Next slide, please. Next, thank you. So how exactly do we then calculate our benchmarks? What is included? So importantly, we start with operational emissions, so scope 1 and 2 emissions from coal mining companies. And here we include methane because the coal mining sector is one of the main sources of methane emissions on a global level. But then we also, of course, include scope 3 category 11 emissions, so emissions from the use of sold product and use of sold products. And this emission category accounts by far for the largest share of carbon emissions, of life cycle emissions in the coal mining sector. So essentially, they are generated once coal is combusted by the end user. Since, as already explained, thermal coal and metallurgical coal supply are expected to follow slightly different projections, in particular in the short and medium term, we've also developed two different pathways and benchmarks. And then there's still a question, once you have these absolute emissions pathways on a sectoral level for thermal coal and for metallurgical coal, there's still a question around how can you make comparisons between an individual company and the projections of absolute emissions on a sectoral level. And in order to enable these comparisons, we index both the benchmarks and the company pathways to a starting point. This starting point is a 3-year average from 2019 to 2021. And we say that the starting point, these 3 years, are 100%. And then everything that follows will be measured in terms of relative changes and percentage changes compared to, again, the starting point. Hayon will explain this a bit more in detail. So thank you, and I'll pass over to Hayon.
Thanks, Nico. Welcome, everyone. My name is Hayon Cho. I'm an analyst for the carbon performance team at the TPI Centre. So in the following session, I will present assessment result of coal mining companies using the methodology Nico just introduced, and along with the key finding from the assessment. So next slide, please. Before diving into the results, I will give a brief overview of the company we assessed. In the 23-24 research cycle, we assessed around 42 companies, and how we essentially select this company is by market cap. So these are some of the biggest coal mining companies in the world. So collectively, these companies represent a market cap of around $344 billion. And just to clarify, the company we choose to assess can be pure play coal companies and diversified firms where coal mining is just one part of their operations. So the total market cap figure includes both and reflects the full value of each company, not just the coal segment. And there are a couple of key features from the company profiles I wanted to highlight because they might be helpful to keep in mind during the panel discussion later. So the first feature is 29 out of the 42 company, which is around 70% of the assessed company, operate in the emerging markets and developing countries. So if you see the pie chart on the left, it shows the regional distribution of company headquarters by market cap. And we see that the majority are based in Asia, and with China holding the largest share. So, but just to reiterate, this size of the market cap of each region does not necessarily mean the value of coal mining operation alone, because it includes the value of integrated company as well. The second feature is about the renewable opportunity in this emerging market and developing countries. And according to the TPI Centre's ASCO project, which assesses sovereign climate-related opportunity and risk, and from their research, about 45% of the prospective renewable capacity is actually located in emerging market and developing country. And I believe this data will give a context, more of context for the later panel discussion. Next slide, please. So before presenting the result, I will briefly introduce how we derive the alignment result. So there are two charts here, and thermal coal on the left and the metallurgical coal on the right. And each line represents a company emission pathway, and these pathways are then compared against this three blue shaded area, which represent our benchmark. And what you see here are the emission pathway of selected companies, and then we compare each company's annual emissions with the corresponding benchmark to determine their alignment. So in order to capture progress across time, TPI Centre focuses on 3 key years, which are 2028 for the short term, 2035 for the medium term, and 2050 for the long term. For example, if you look at the orange lines on the top in the thermal coal graph, which present under energy, and you will see their emissions remains above all benchmarks through to 2050. And this means that they are not aligned in any of 3 benchmarks across all time frames. And if you also look at the green line right below the orange line, which shows our console energy and their emissions in 2028 fall below 2 degree benchmark, but remain above the 1.5 degree benchmark. So they are considered below 2 degree aligned in the short term, but in both 2035 and 2050, their emissions exceed all benchmarks. So which means that they are not aligned in medium and long term. Next slide, please. Yes, as we just seen how we generate the alignment result. These slides now present actual outcome for both thermal and metallurgical coal. And each bar chart shows the shares of companies aligned with our benchmark across 3 key years, 2028, 2035, and 2050. And here you can see a similar pattern across all timeframes. And the green and the yellow bands at the top represent companies aligned with 1.5 degree and below 2 degrees. But those categories are very small, as you can see, which shows that the most companies are not aligned 1.5 or below 2 degree scenario across all short-term, medium-term, and long-term. Although the first part on the left, which is a short-term alignment for thermal coal, it shows a relatively higher share of 1.5 degree or below 2 degree alignment. This does not necessarily indicate a credible transition pathway, because to see whether the company has a clear pathway away from the coal, it is more important to see whether the company stayed below the benchmark across all years. And also, short-term alignment often is a reflection of where the company's business model is at present time. So that's why it's much easier for a coal mining company to be aligned in the short term versus medium term and long term, which requires ambitious ambitious commitments. And second finding is, if you see the green segment in the thermal coal, that persists across all 3 years. And that is because 2 companies are aligned with 1.5 degree across all time frame. But this alignment is not the result of gradual or strategic phase out of coal. Instead, these 2 companies sold off their coal assets, which leads to a sudden drop in emission to zero. And also, but we did not observe this kind of cases in the methodological coal. And lastly, one of the most important issues here is the lack of disclosure. So the black bars at the bottom represent companies that do not provide enough data for us to be able to assess them. And in most of these cases, the missing piece is sales volume data for specific coal types. This is critical because we calculate scope 3 emission fully in-house using IPCC emission factors, just as we do for our benchmark calculation. And since scope 3 emissions make up the majority of the total emission in this sector, so not disclosing this sales volume makes us unable to build a company emission pathway that is comparable to our benchmark. Next slide, please. As we have seen, coal mining companies are mostly misaligned with any benchmarks, and this is related to the nature of the targets company have set. So this slide presents a more granular analysis of companies' targets to help explain the widespread misalignment in this sector. Starting with the numbers on the top left-hand side, we see that 11 out of 42 assessed companies have set any emissions reduction target. And looking at the time frame graph on the bottom, we see that 8 out of 42 companies set target in the long term, so between 2036 and 2050. And this number drops gradually when you consider whether the same company has also set target in the medium term. So, and further again in the short, medium, and long term. And this final bar chart, we see that only 1 out of 42 companies set targets across 3 time horizons. And again, just to reiterate, it is important to set target across all 3 timeframes because of the cumulative emission. And so beyond the time frame, another dimension which is critical in coal mining sector is the coverage of this sector. On the right-hand side of the chart, we see that same 11 company, or 26% of total have set some form of target in any given time frame. But all of these targets cover only scope 1 and 2 emissions. None of the targets cover scope 3 emissions. And again, why the scope 3 emission target is important is because scope 3 emissions account for the majority of the coal mining companies' total emissions. And so the absence of scope 3 targets makes it extremely difficult for this company to align with our benchmark. Next slide, please. And so this is our final insight I wanted to share, is a comparison of long-term alignment across sectors. Since this is our first coal mining assessment, it would be helpful to place the results in the context of other carbon-intensive sectors already assessed at the TPI Centre, and to understand where the coal mining sector stands in its transition trajectory. So this bar chart shows the long-term alignment share of different sectors, and the coal mining is at the far right. And compared to other sectors, what stands out immediately is the coal mining has the largest share of red and gray segment, which means that they have the highest share of companies that are either not aligned or lack of suitable disclosure for both thermal and metallurgical coal. And this making coal mining sector with the lowest proportion of the companies aligned with 1.5 degree in 2050. Next slide, please. Okay, now I will close up my presentation with echoing these three findings. And first is coal mining sector is a far off track for 1.5 degree alignment across all time frames. And this is mainly because companies are not setting enough targets, and where they do set targets, scope 3 emissions, which are the material emissions, are not part of them. And compared with 11 other sector TPI assesses, coal mining has the lowest alignment rate. And with that, I will wrap up here and happy to answer any questions related to the assessment results during the Q&A session. So I will hand back to Ali. Thank you very much for everyone for listening.
Great, thank you very much, Nicholas and Hein, for the presentations, and especially unpacking the methodology and assessment results for us. I think clearly the message which was provided at the start of the presentation on the coal's significant contribution to global emissions, it now sits rather uncomfortably with the misalignment that we see as part of our first assessment cycle by some of the biggest market players that we've assessed in this sector. And that gives us quite a strong foundation to kickstart our panel discussion, where we can take a step back and see how the sector in general fits within the broader themes of transition, such as sustainable investment, energy security. What is the role of emerging markets here? And hopefully this will give everyone watching this webinar some key learnings to take away within your own respective work and areas. So I'd like to start the panel discussion with you, Mathilde. So OECD has been supporting governments around the world in transition to a low emissions yet a resilient global economy. In this context, how alarming or how telling do you find these results that TPI and Hein kindly has presented today?
Thank you. Thank you first for inviting us to this seminar. It's very interesting to see your results. And really, the results of this assessment, TPI assessment, are at the same time very telling. And they do underscore the importance of a full value chain approach in the transition towards net zero. And they do confirm three key conclusions that we have also drawn from our own work and ongoing work. First, that to achieve net zero emissions by 2050 globally, the world needs to transition away from fossil fuels, and we cannot cherry pick the sectors, and definitely we cannot ignore the coal sector. And second, we are very much off track currently in achieving our targets across most sectors, but even more in the coal sector. And it was very visually visible, in one of the last slides. And third, but I will come back to that, we need to make sure that the transition is just and that we ensure energy security and access, because yes, there is a growing energy demand, especially in the emerging and developing world, and this growing energy demand needs to be addressed. So, as you said in the presentation, according to the IEA, a net zero emission scenario, the global coal use needs to fall by 90% by 2050. This will be super difficult, and to date, most of the international efforts around the coal transition are focused on reducing emissions from coal-fired power generation, and notably through, as you said, demand-side measures like switching and blending with low-emission fuels or CCUS, carbon capture, utilization, storage, etc., or increased energy efficiency. And this focus is reflected in the public or the private sector initiatives, such as like the Powering Past Coal Alliance, as well as in the existing international commitments, for example, in the context of the G7, where countries have committed to phase down unabated coal generation. But the coal mining, really itself, that is the focus of your research, has yet to receive the same level of attention from the private sector as well as from the policymakers around the globe. And there are a couple of reasons that can explain this. Is that first, everybody is afraid of the negative potential social impacts on local communities because, you know, the job losses, if we are getting out of this coal mining, the job losses will be very first high and concentrated, especially in emerging and developing economies, where it is forecasted that there would be 2 million workers that would be affected compared to 325,000 in advanced economies. So there is this concern. And I go back to this energy security concern and energy access concern, especially in the current geopolitical context, I must say. So basically, we need a massive scale up of clean energy and network investment. And we are really like, our global debt report of this year shows that in a baseline scenario, the emerging and developing economies would face really 10 trillion investment shortfall to achieve net zero by 2050. So against this background, and against the TPI analysis that you just presented, I'd like to draw out 2 key points that should be, from our view at the OECD, priorities for government action, because that's where we are acting, at the government, at policy level, to push for the transition of the coal mining sector in particular. And this is very aligned with also your analysis. First, we need to transition. We need some transition planning and net zero targets that cover all relevant emissions. And the TPI findings show that most of the companies assessed did not set a GHG emission target, and none covered scope 3 emissions in their targets, despite them being the main source of those companies' GHG emissions. So our analysis concludes that transition planning is key for high emitting sectors, and that includes, of course, coal mining, and that targets should include scope 3 emissions to be relevant. And as it is obvious, there is a long way to go for mining companies, and maybe specific guidance for governments and by governments could be helpful, and that's where the OECD is active. And the second main point is that responsible exit from coal mining asset is critical. And your assessment is absolutely telling on this point, because you find that only 2 out of the 42 mining companies assessed were aligned with 1.5 degree, and because they sold their assets. So, well, it's good for them, but it's not efficient in terms of reducing emissions. So responsibly exiting from coal mining assets means actually reducing emissions in the sector by ensuring that the mines are closed over time, and also that the social impacts are addressed. So this is a key point also in our analysis. First, transition planning. Second, responsible exit from coal mining assets. Maybe I'll stop here.
Great, thank you, Mathilde, for the insightful response. I really liked, I suppose that's the challenge with most of the sectors that we see in this, trying to find this balancing act between energy security, growing needs of humans around the world, but also the scrutiny and emphasis that's placed on decarbonization. And I think it's difficult to find the balance sometimes for corporates who are operating in regions where you see a growing demand of energy, but at the same time, you're expected to decarbonize at a quite a rapid rate. There are a few questions that I would like to follow up on. Maybe in the interest of time, I can move the conversation to you, Jason. From a portfolio manager perspective, how have you found TPI's Centre results in this sector? And maybe you could touch upon how asset managers, asset owners around the world can use this data, but more so those operating in emerging markets where, as Mathilde mentioned, there are these tensions between the growing need for energy, but also the need for decarbonization.
Thanks very much, Ali, and appreciate the chance to speak. The TPI is really a great resource for us on the investment side, and I'd like to explain why. Now, first of all, what were the kind of the key surprises, I think, from this, and especially watching the presentation. As Mathilde mentioned, quite a lot of gray. I mean, black we can understand. I mean, red we can understand, but kind of the black, the lack of data. And it's really not that hard to understand. I think we've coming from a place where a lot of investors, I think, have relied on exclusionary policies, ESG scoring models that are basically exclusionary in their nature, and so probably not a lot of sustainable investors have been that active looking at for example the coal mining sector for obvious reasons, and that's probably why they've so far been able to, without much cost to them, besides the beta, not have to disclose these things. So it is important now that we are in this current geopolitical environment, and there are challenges to the momentum of the sustainability agenda and climate, that we take in all of the just like we're taking in all of the above approach. I think in some contexts to energy, investors also need to have this type of shall we say, kind of system update. So less exclusion and more sort of an inclusive approach. And so we need to be asking all companies in all sectors to first be disclosing. Now, how do we use this type of data? I think there's three things that really stand out to me. First of all, why is TPI data so critical to the market? It gives us a comparable benchmark for bottoms-up analysis. Especially if for us in the credit side and fixed income, it's very important to have our key driver of risk and return is basically the downside risk. So we are comparing companies and issuers, against each other. It's good to have like-for-like data. It's very good to have a broad base, as universal as possible, in fact, of that bottoms-up data, so that at the end of the day, we can be doing the analysis at every step of the investment process to say, buy this, not that. And even in the coal mining sector, as kind of shocking as it may be, we need to be doing that. We need to be saying, okay, if we have an exposure to this, whether it's literally a coal mining company or a mining company with coal operations, or maybe a Japanese trading company that has that is facilitating the trade of coal, et cetera, how do they compare to their peers? What is best practices look like? What is the checklist that we should be looking at and asking for when we're engaging? And these are all factors in the TPI analysis that make it very clear and give us that comparable source of data for a bottoms-up analysis. The second thing I think is it encourages disclosure. And I believe that as we kind of shine a light on this sector as well, which has been honestly not probably on a lot of sustainable investors' radar, but we also need to consider it. It's part of the real economy. Coal is a thing, and we can't just close our eyes and wish it away. So by getting this type of data out there and for investors to use, because honestly, not all investors have the same level of sustainability preference, right? Not all bonds are green, and not all investment funds are sustainable and ESG. So I think, and I hope it's useful to a broad, to the mainstream investors, anyone who's looking at this sector. I mean, you can imagine, I think increasingly going forward, and really this is true for any sector, how can you really be doing your job as an investment manager or an analyst if you are not considering the transition risk to the sector, and who's better, who's worse. So even if you're not necessarily operating under a sustainable investment mandate, I think this data is very useful for pretty much everyone in the market. And third is it really gives accessibility. It's really accessible to the market. We do not have necessarily 50 climate PhDs working in every single investment management company, right? And I think, to be honest, that's kind of more especially true in Asia. So it's very good for the market to be able to have open access, free access to this very high quality, vetted, academically rigorous, scientifically based data that everyone can kind of look at and use. Again, it's almost even if an investor has, let's say, an amazing proprietary model and all the resources in the world, and they're arriving at these amazing insights, but if it's only them who has that insight, is that actually going to get priced into the market? If no one else knows, it may not actually get into the price. And ultimately, this is how we're going to move the needle and keep the momentum going. Even as the policymakers in some parts of the world step back, markets still need to be pricing in. It's part of our fiduciary duty, these risks, and maybe the speed of that is changing, or the regional focus is changing, but it's still a risk. We need to be pricing it in, and everyone needs to have this data. So sort of democratizing that data, I think, is another key thing for this market. I mean, we've seen in our examples, we have business and operations in Malaysia, for example, where obviously the coal, less so the mining, but really downstream, obviously in the coal power use, is very much dominated by fossil fuels, and especially coal. And if you come into it with the mindset of, okay, we're only going to invest in green bonds or renewable energy, I mean, basically that's literally 1% of the market there in the bond market, that are maybe green bonds. So I think it's really helpful to have this kind of bottoms up data that we can use to say, okay, here are the different issuers, here's where they stand. Maybe in terms of temperature alignment or transition alignment, it's not great, but we set a baseline. We know who's better, who's worse. We can start with the portfolio there, and then manage that over time through engagement and kind of active risk taking to manage that down in a more sustainable way. And again, I will kind of end with saying that, again, it is just so useful to have that sort of one axis of analysis. It makes it so easy and so intuitive to use. Not everyone on these desks is a climate investment expert, right? People are very busy. They have a lot of things to do. And it's very good to be able to show, okay, here are the companies in this industry. Here they all are on the same axis of analysis, and you can see with your own eyeball, who's potentially de-risked relative to the peers in terms of transition risk. And then, is that in the price? Yes or no? Okay, your job just got that much easier. And that is how we can make this data work in real life.
Great, thank you, Jason, for the response. If I was to summarize, I suppose very quickly in a few words, you particularly value the comparability and accessibility of TPI's data, and one of your core, I suppose, recommendation is within your investment exposure to these sectors, there needs to be a balanced approach rather than always using the stick of negative screening. I'm conscious of time, that we have 13 minutes left. We want to ensure there's plenty of time left for Q&A at the end. So for our next sort of set of questions, if I could please ask the panelists to summarize your answers within a 2-minute time frame, that would be very helpful. We can turn our attention to you, Hayan, on the assessment results themselves. So just for our audience, coal mining is a sector that we've assessed on our qualitative part of the corporate tool, which is management quality, where we assess the company's governance structure, its metrics, and some other recommendations along with TCFD themes. But this is the first time that we are assessing coal mining within carbon performance. Would you be able to speak on what difficulties you found within the assessment process, and what sort of recommendations you have for these companies going forward? Because, as you know, what we see is, after we do an initial assessment, we generally see an improvement in company disclosure. So if you could please speak on those points, that would be great.
Yeah, sure. Thank you, Ali. From an assessor's perspective, one of the key challenges we faced quite a lot was the limited availability of disclosure, not surprisingly. And as we already seen during the presentation, many companies either do not disclose the data we can use, or they do provide data, but not sufficient for us to use in the assessment. And this is a particularly challenging for kind of diversified company, and which make a large portion of the sample. And in many cases, we noticed that it's very unclear which part of their business are involved in coal mining, and making kind of difficult to isolate this data specific to coal mining operations. And also another factor could be, as mentioned during the presentation and panel discussions, and 70% of the company we assessed in emerging market and developing countries. And in this reason, like, a kind of detailed and consistent corporate disclosure is less prevalent than in developed markets. So this disclosure gap makes it like especially challenging for us to apply assumption in a very consistent way. And for instance, if a company does not report scope 1 and 2 emissions specifically from coal mining, and we need to come up with the solutions for how to estimate them, or if company-wide emissions or group-wide target are disclosed, how are we treating them, and how do we determine whether and how it applies to coal mining? So in order to make reasonable assumptions, our analysts do lots of external research wherever possible. But again, this kind of gap still introduce kind of challenges for us to ensure this accuracy and consistency across assessment. So with this in mind, we would like to see more disclosure, the data disclosure and data that we can use in the next assessment cycle. And in addition to this improved data availability, we would also like to see more meaningful target setting, because one of the main reasons for misalignment in this sector is a lack of target, particularly on scope 3. And although there are 2 companies aligned with 1.5 degree, but they achieved it by selling off their coal assets entirely and not shutting them down, which doesn't necessarily indicate a real reduction in global emission. And those emissions have simply transferred elsewhere. So, and also according to the IEA net zero emission scenario, thermal coal should be phased out from the electricity generations by 2040. So we hope to see the target that align with this timeline and which requires material emission reduction. And they should be underpinned by a clear and planned winding down of cooperations rather than just like selling out their asset. Yeah.
Great, thank you, Hayan. I mean, maybe to reiterate, it sounds like we are doing our best to make sure that the proportion of known suitable disclosure remains low with some of our assumptions. But I suppose there's only so much we can do if there's massive gaps in company disclosures, especially on the sales side. Switching our attention back to you, Jason. You already touched upon these points about the changes in geopolitical situations around the world and what that means for decarbonization as an agenda for corporates, but also governments. But maybe just to get your views on how can you make sure as a portfolio manager that decarbonization and climate change still remains as a priority for you, despite these changes that we see in the landscape and environment that we're operating in?
Sure. Again, I think that this type of bottoms-up data that that the TPI provides is so key to maintaining the momentum at all levels, even with these types of headwinds that we're facing. And I think I honestly I think you could see that challenges from political economy type of challenges we're going to come up when it comes to energy, which is so key to people's lives and development. So that itself is not so much of a surprise. But what the investment side needs to do is I think really embrace the need for transition finance and more of a less of a binary approach, less exclusionary approaches, and more of that bottoms up fundamental integration in the fundamental research and fundamental analysis of all companies across the real economy. And so this type of analysis, whereas it probably we wouldn't have expected it, about 5 years ago. I mean, no one, I don't think, in the sustainability world was looking at these. They were just writing them off entirely. But it turns out that we actually need to look at that. And what I think is so interesting and so powerful about it is that, as Hayan was just mentioning, the need for more disclosure. How do you get that? I think it's very interesting that you're basically kind of crowdsourcing the disclosure ask onto the market, right? Because we are seeing this data. If I and other investors can use it to make alpha or to avoid risks for our clients and preserve their capital, that's great. And part of that process is going in and saying, look, you're an issuer. We'd like to maybe fund you, but here according to this data, this TPI data, you're missing these key indicators, and that makes it much harder for us to actually engage with you as a financer, and probably others in the market. So why don't you think about maybe disclosing that? It kind of gives them that skin in the game. If everyone is sort of doing that, then you can see how suddenly it's people are motivated to not just hide, but actually to disclose. And that's how we can at least keep the momentum going, even with the challenges.
Thanks, Jason. I think that's a really good point, because even if TPI is saying a lack of disclosure or no unsuitable disclosure, that can essentially also be used as a data point to start engaging with companies to get them to disclose the right things in order to be assessed. We have 5 minutes left. I unfortunately have to ask Mathilde for you to be very concise with your answer here, but I think it'll be wrong to not get your experience and expertise here on this question. So as Hayan mentioned, we have quite a lot of growth expected in emerging markets in terms of renewables. But again, the energy security and all of these issues coming in as well. What would be your sort of core recommendations to governments around the world in how they can balance and tackle this challenge of growing energy demands, but also the need for decarbonization in sectors like coal mining and oil and gas, which are very carbon intensive?
Okay, so I will try to be super short. So first, a key message is that finance alone cannot fix the underlying structural barriers. So governments need to have an overall regulatory and policy framework that is conducing to making the renewable energy efficiency project attractive. This is key. And there are maybe 3 areas of priorities on which we are working currently. It's first, paying attention to the transmission grid financing, because this insufficient grid capacity these days have become the largest bottleneck worldwide. Of course, it's true in emerging and developing economies, but it's even true in advanced economies, as we could see like two weeks ago in Spain with the massive power outage. So this grid transmission grid financing is a key issue to look at, to focus on in terms of financing, and we will have soon a new study on that. And the second point is in terms of the MDBs, the multilateral development banks, and also the bilateral donors, they have a critical role to play in increasing the availability and the effectiveness of blended finance and other de-risking instruments for clean energy. So because what we see is that the public money is not mobilizing enough the private money, and we are reporting every year on the 100 billion goal, and we see that only 18% of this goal is from private finance. So that's a key area, using the public money to really mobilize the private finance. So that's the an advice that we give to our members and beyond. And the third point is that maybe the financial regulators and the supervisors have a key role to play to strengthen domestic green financial markets for clean energy. And that's also work we do. For example, we have developed guidelines on climate transition planning for financial institutions and for corporate listed companies in Indonesia with OGK. So these are my 3 points in a nutshell.
Thank you, Mathilde, and thank you for keeping it so concise. We can move to sort of a very fire round question and answer session here. I see, Hayan, you've kindly already started to answer some of these questions. So if you have proposed your question, we are providing written answers in the Q&A box. But maybe to pick a few of these, I see this one is maybe most relevant to you, Nicholas. If you could please elaborate on what you mean by carbon efficiency and what this implies for the coal mining sector.
Sure. So carbon efficiency essentially refers to how efficiently, from a climate perspective, a company can operate or produce a certain output. So it's typically measured in carbon intensities, and carbon intensities can again be measured in different ways. So in the numerator, you will have emissions, and in the denominator, you have either financial metrics such as revenue or production-based output. That's how we do it at TPI. If you use a financial metric in the denominator, then the carbon intensity essentially shows you how much carbon has been emitted by a company to earn $1 of revenue. If you have a production-based output, for example, you would be able to see in the cement sector how much carbon was emitted by a company to produce a ton of cement. And the key point really to remember for the coal sector is that carbon efficiency is much less relevant compared to other sectors, because coal mining on a global level is expected to shrink. Coal supply in a 1.5 degree scenario is expected to shrink.
Thanks, Nico. I see some of these questions are mainly related to our assessment process, which Hayen is attending. But I do see one which is perhaps most suited to you, Mathilde, in relating to policy legislation. In how are there any good practices that you can recommend in policy legislation that ensures that companies operating within certain sovereigns calculate and disclose Scope 3 emissions as required under Greenhouse Gas Protocol or some of the other frameworks out there? So are there any practices that you would recommend governments to implement to make sure that the companies operating within those countries are actually disclosing the right information for assessments?
Yeah, there are good practices, and we have OECD standards that try to advise governments on what type of standards in their turn they should put in place. And I should refer firstly to our RBC standards, responsible business conduct standards, that require, in terms of disclosure, transition planning, in terms of, scope 1, 2, and 3, etc. So I would advise maybe the interested companies or investors to look at these standards. And we have some specific guidance for institutional investors, for example, for the financial institutions, so that you have this responsible business conduct that includes, obviously, responsibility in terms of sustainability.
Great. Thank you, Mathilde. Hope the resources are useful for our audience. I see a lot of questions relating to the slides themselves. Yes, I believe they will be shared after the webinar. And I do see that we've unfortunately run out of time, but I'm pretty sure all of the questions that you have proposed will be answered in the Q&A chat box. And with that, I will bring the webinar to a close. And again, thank you to our panelists, Jason and Mathilde, for joining us today, and for Hayen and Nicholas for presenting the TPI Centre research, and to all the audience for joining and listening in. And with that, we can close the webinar. Thank you very much.
Thank you for the good data.